Good evening, students. Welcome to Tax Secrets for Real Estate Wealth. This is Seewing Yee, your instructor, on behalf of Los Positos College Community Education. So, welcome. So, I'm going to ask you before I begin in about 5 minutes, if you could hear my audio as well as see the screenshot of my PowerPoint title presentations. Go ahead and click on your chat box once again. You know the drill. So can hear and view your screen. Perfect. Please go into presentation mode. Yes, I will go into presentation mode momentarily. Just just give me one moment. Let me see. Most of you are already logged in, and yeah, most of you are logged in. So right now, at the top of the hour, there are several people that will be fashionably late, but it's okay. So without further ado, let me enlarge my screen, and we're gonna proceed. This could be a long event. Well, anyway, welcome once again, students. Some of you have attended the first two online training sessions. The Los Positos College Community Education, for obvious reasons, are doing online training. As an instructor, I've been teaching for Los Positos College for many years, since 2006, off and on. And needless to say, I've been teaching live classes, and because of the current situation, we have to resort to online training. So I'm adapting, just like most of you out there. This pandemic situation is changing the way we live, work, and play, if you will. So it's all about, adapting. So anyway, so this presentation will be recorded. All right. So you will have, many of you already received the webinar replay recording for the first two modules, Monday night and Tuesday night, 6 to 9 p.m. by Real Estate Property Out of State, part 1 and part 2, 3 hours each. So this is the combination of our training package, if you will. I call it Real Estate Boot Camp, for the lack of a better term. I call it boot camp because I was in the U.S. Army, active duty for 20 years, retired back in 2002. So if anybody who is legitimately qualified to call this overused word in real estate seminars boot camp, I would say I'm qualified to say this. So anyway, tax secrets of real estate investing. So let me give you some disclaimer. First of all, I'm not giving tax advice. In order for you to go over your situation, please consult your own financial professional, your licensed tax advisor, your licensed tax attorney, and your licensed financial advisor. I'm not a licensed tax advisor, but I play one on TV. No, just kidding. I can't wait to say this. All right, I'm going to make this. Although I have prior to 2004, I was a real licensed tax advisor. So that was years ago. I do not practice tax anymore, but I do know a lot because I'm a student of my profession. Not only I study a lot about tax as it relates to real estate, because I'm a real estate investor. For many years, I've purchased properties throughout many locations throughout the U.S. for the past 16 years. So I know the real game. I come to you with a lot of experience with real estate investing, turnkey real estate investing. and most of you know what I'm talking about. So tax secrets for real estate investing is, again, I'm providing general education. Please do not ask me any questions about your unique personal tax situation. I'm not in a position to answer them for the reasons I just uh, provided. So, but you are welcome. I do welcome you to throughout the evening, perhaps the last 1 hour, maybe even the last 1 hour of this training, to put down your questions on a chat box. I'm going to go through the presentation. This PowerPoint will last maybe like 90 minutes, right? So I may take a couple of questions throughout the first 90 minutes, but most of the questions I will defer until toward the back end of this presentation, which is this presentation from 6 to 9 p.m. So this PowerPoint will finish in about an hour and a half, which is until 7:30 or so. So 7:45 until 9 p.m. or earlier. We can finish earlier perhaps, depending on how many of you will ask questions. On the chat box on your control panel, obviously, you know the drill. Some of you have attended past few nights, so you start asking some questions. You don't wait until the last 1 hour before you ask questions on the question box, on your chat box. You may do it as I'm doing my presentation. Is that fair enough? Okay, well, I can't hear you, so you can chat box me. You can type in the questions to acknowledge what I'm saying. So, okay, without I want before I begin, okay, let's proceed. I think we're good. All right, so this is a sort of a beginner's guide to tax strategies. I assume most of you are sort of newbies in this business of investing in real estate. So I'm gonna do my best to make this tax a very dry subject into somewhat fun, right? I do not want to be robotic, but if this tax seminar is are taught by a real accountant, a CPA, or a tax attorney, they will probably to especially the monotonous tone, they're going to put you to sleep. Oftentimes, a real practitioner in tax area, they do not how to how do you say that? They do not how to put it, explain it in a way in a layman's term. You know what I mean by layman's term? The regular people out there who are not tax experts. I, on the other hand, I have to say, I have done a better job over the years to explain tax strategies in a very simplistic layman's term for the common people. So I could be wrong, but all right. So since this is only a few-hour class, I can only share with you some basic concepts, but it's from a high level. I'm going to teach you from a high level. So we're going to go through some real-world application. I'm going to use a sample rental property and plug the number from the cash flow analysis later on this PowerPoint presentation and put it in a tax return so you can see the real application of how to apply certain tax deductions and strategies into a rental tax return so you can see the real savings, the real tax savings associated with buying investment real estate. Okay, is that fair enough? Okay, fair enough. All right, let's proceed. Again, my name is Seewing Yee from the Real Estate Network, and I own a real estate investment club, a network here in Fremont, California for the past 16 years, as I stated. So that is my expertise. I'm a licensed real estate broker in California only, but I have a very good understanding of many areas of financial planning. So I have a lot of comprehensive background over many years. So I look at the big picture. I look at the holistic point of view, the financial planning with respect to real estate investing as the main core strategy for my investors. And you have to understand the secondary financial information you must know. Okay. All right. So let's proceed. So there are three sources for earnings, and of course the earned income, which unfortunately most people are just what they do, right? Most people have a regular job, you know, they work 9 to 5 or whatever, 9 to 7, something like that. But anyway, all right. So, oh, by the way, some people making confused. You log into the wrong link. You're supposed to log into on a proper link. Tax secrets for real estate investing. Each class is a separate link. Do not use a previous link that you attended the previous night. So you're not going to be able to log in. So I'm trying to look at my cell phone, make sure everybody is logged in correctly. I assume that you are. So yeah, so everybody caught up with it. All right, all right. Actually, one person, Laura, if I think you might have logged in on a wrong link, but I think you have found the right link just one moment ago. Curtis, I think you almost logged in the wrong link, so I assume you're on this link on this presentation already. All right, getting back to this. So most of you do have earned income, you have a W-2 income, right? If you are earning like 6-figure income, like 200K or even higher, as you know, you're in the top 35% tax bracket, right? Very, very high tax bracket. And in the state of California tax, another the top rate is around 9.3%. So right, if you do not create tax deductions, pretty much almost half of your earnings can go to the Uncle Sam and Uncle the other uncle state California uncle. So you need to stop giving your hard-earned money away, because at least the first 4 months of your W-2 earnings go to your two uncles, Uncle Sam and Uncle State California. So that's why potentially you're doing real estate investing, right? But anyway, so you as investor, all you need is to have some basic understanding of real estate. Then once you start buying rental properties, then you will learn by doing, and you will hire your team of financial advisors, including your tax advisor, CPA, whoever. Okay, so surround yourself with a team. We discussed about that on a previous training. So earned income. So most of you have earned income only. So some of you, if you're a good investor, good saver, you have portfolio income, as you can see right here, portfolio income or stock market, mutual funds, right, that you've been doing all along, you know, which is fine, but perhaps maybe that's not enough. Portfolio income. So portfolio income, the interest income coming out of your mutual funds are taxable, as you know, right? Dividend income, capital gain, potentially are taxable as well. So it's good or bad in, you know, in investing in portfolio income. And finally, passive income, which something I really like, obviously, real estate strategies. So if you could diversify your earnings, your money into real estate investing, which is passive income, that will really potentially can accelerate your financial freedom goals if you have all three. Or, you know, be nice to have all three, so you can have multiple streams of income in your future, so you can achieve your financial freedom goals. Earn income, portfolio income, and passive income, right? So we can discuss mostly passive income this evening for obvious reasons. All right, so let's proceed. For tax planning concepts, tax deduction, which you've been getting if you own a principal home, right? Which is your Schedule A tax deduction, your home mortgage interest, which has been limited to a certain limit, $1 million, I think. So yeah, not as much deductions on your Schedule A on your principal home deductions as you have in the past due to recent major tax law changes. And then the second category is tax deferral, which we can talk about a little bit later this evening. The tax deferral aspect is the 1031, the section IRS tax code, section 1031 tax defer exchange. Of course, we will talk about that in the back end of this PowerPoint presentation. And then tax exclusion, we tax exclusion is talk about your principal home, your owner-occupied home. We may talk a few minutes about that. Then tax conversion, you can recharacterize your principal home into a rental property. Yeah, we may talk about that as well. But most of it, we can talk about your rental tax return. We're going to go over each input little by little. We can have a sample tax return. We can have a sample property. So you can make a real world application, turn the theory you're going to learn the first hour of tonight into a practical learning. It'd be great if I can teach you in a live class environment, because the interaction is better. But hey, that's it is what it is. We have to adapt according to the current environment. Okay, so let's proceed. So tax benefit of home ownership at the time of purchase, at the time that you're living in your principal home, at the time that you sell your home, either owner-occupied or non-owner-occupied. We'll discuss that. So yeah, some of the slideshow I'm going to skip because I don't want to, because I'll have my discretion whether I'm going to skip a particular slide or not, because some of these slides are not that important in the whole scheme of things, right? We're going to focus on the things which I feel as an instructor are important to my students. All right, so you know, this several slides only going to talk about your your closing statement on a property that you're closing escrow. So I'm not going to use too much mumble detail, but when you look at your closing statement, when you close on a property, some of it is deductible in a year of occurrence. Some of it is amortized over the life of the loan. Some of it is non-deductible. So again, something you need to be aware of. So you need to consult with your loan agent when you close escrow, when you receive the closing statement for the loan agent to give you a high level understanding what are some of those the closing cost means, right? So I'm not going to talk about that. It's just very technical. Okay, so yeah, see, as you can see, you know, the settlement statement, the HUD statement, if you will, yeah, a lot of it is non-deductible. Of course, these are the following items, but some are deductible. But anyway, so let's talk a little bit about your principal home. Okay, I'm going to make some unique distinction when we approaching each particular slide. I will clearly let you know whether we're talking about principal home or we talk about rental property. So this is a very big distinction, all right? But we can spend time mostly on your rental tax return, right? Okay, but this time on this slide, we talk about your principal home deduction schedule A we discussed, and so which is, you know, which I already kind of discussed, your mortgage interest, your real estate taxes. So and now this one we can talk about your rental property, your non-owner occupied property, your pure investment property, right? So whenever you buy investment property, you need to kind of itemize some of these items, because these are depreciable items. We could talk more about that. I'll give you some hint. What are the tax terminology we're gonna learn about later on this presentation, later on tonight. When you're able to itemize some of these items, when you purchase a big investment property, by taking good record keeping, there is some depreciation. There are several categories of depreciation, right? There are regular depreciation. You can depreciate over 27.5 years, and then there are some items or can be depreciated quicker in over less time frame as opposed to 27.5 years. So just keep that thought in mind. We can discuss in more detail about different types of depreciation, which is a paper loss, which may further reduce your your rental income subject to ordinary taxation when it's all said and done. So, okay. So just keep an open mind. We'll provide more details. Some of you may not understand what I just said. So new roof, new floor, window, doors, whatever. So yeah, and of course, these items, these are detachable items from your structure of your investment property. They can be depreciated at a accelerated level, like a 5-year depreciation method or a 7-year depreciation method, which will give you much more upfront paper deduction associated with your rental property deduction. Does it make sense a little bit? I hope so. All right. Okay, let's go back to your home a little bit. When you sell your think about this is your principal home, okay? I know we're going back and forth, but just just pay attention. I mean, if you lose concentration or focus throughout the training, you can get a recording of the video of the entire training. So you can always play back, and the second and third time you play back this seminar video, you will understand even more. Okay, so repetition is the mother of all learning. You know what that means? Repetitions. One time hearing a topic or something, you may not get it. Second, third time, do it again, you get it. Let me give you another example. Like when you watch a movie, right? When you watch a movie for the first time, a 2-hour movie, you kind of have a mostly understand it, but certain scenes you may kind of you lost concentration. But then a few years later, when you see the same movie again, right? Then you said to yourself, oh, now I get it. The first time you watch the movie, you may not get the whole thing in all the details. Second, third time, a lot of the classic movies, which I like, classic movies back in 1960s, 1970s. I love those classic movies. You know what I'm talking about. I watched those movies 3, 4, 5 times, even more over the years. And the third, fourth time I watch, I always, gain a better understanding. So, learning about taxes or anything about real estate is no different. The first time you may not able to fully understand it all, but when you repeat the process, repetition. Okay, so ingrain the word repetition in your brain when you go through your real estate investing journey. Does that make sense? Okay, getting back to this, when you own your owner-occupied home, that's what I'm talking about, right? Over a period of time, if you were to sell your principal home, okay, when you sell your principal home at a profit, right? Then, if you're single, ordinarily you have to pay a capital gains tax whenever you sell a asset which is greater than your original purchase price. So real estate is no different, and owner-occupied property is no different. So let's say you buy a home, 10 years ago for for 500,000. Now 10 years later, that $500,000 property here in the Bay Area is worth 1 million, right? Oh, okay. No, okay. Okay, let me put it this way. Yeah, okay, 1 million. Get it? Let's say you're married filing jointly, okay? Husband and wife. So if you bought your home 10 years ago, your principal home for 500,000, right? And you sell it today 10 years later for 1 million, guess what? You have a $500,000 of potential gain. Am I right? Okay. So that $500,000 potential capital gain, ordinarily you have to pay capital gains tax, which is around, I believe it's 15% now. However, you could take advantage of this universal tax exclusion. So you marry filing jointly, up to $500,000 of your capital gain after you sell your principal home is excluded from taxes. It's called universal tax exclusion. However, if you are single or divorced or whatever, and you bought your house, the same scenario, you bought your house for 500 grand 10 years ago. Now you sell it for 1 million, you have a $500,000 capital gain, right? But if you're single, you can only exclude to $250,000 from taxes. But the remaining excess of 250K is taxable at federal capital gain, whatever tax rate at the time that you sell. So you can have to pay tax on the difference to 150K, multiply by 15%, whatever the amount is, 40 grand, 45,000, something like that, right? You get the idea? All right. So, however, okay, let me see what else. I'm gonna skip some of these slides. So yeah, this kind of, okay, I'm gonna touch on a little bit over here, the inheritance. Now, let's say you own any kind of real estate, whether you own a real estate that you as a principal home, or you own real estate property, a rental property. So let's say you say it again. I mean, you own you bought it. Let me use the same example. You bought your house at $500,000 value 10 years ago. And today is worth $1 million. So if a owner probably passes away for whatever reason, the beneficiary, the estate, whoever is the beneficiary, will inherit the property. They can inherit the property at the step-up basis. The word step-up basis mean at the time of death, the step-up basis is still $1 million, right? Because that's the value of the $1 million. So your beneficiary or your stake can inherit your real estate asset at current value. So you're not going to pay any taxes, even though your property have gained $500,000 in this example. There's no capital gains tax at all, because the beneficiary will inherit the property at a step-up basis. So there is a tax benefit when someone dies. Okay, I mean that's the fact. So I know this is an emotional subject, but that's why as a real estate investor, or if you own a lot of houses, or even one principal home only, it behooves you, unless there's a very good reason to sell, right? It's important to hold the property forever, right? Enjoy the passive income and the equity associated with a long-term real estate ownership, and then enjoy during your lifetime, right? Then at the time of death, of course, prior, you do some estate planning, like put together some living trust, whatever, so you could avoid probate. And then at the time of death, all your assets, not just real estate, will receive a step up in basis, and your beneficiary, you're not going to have to pay any of the taxes on when they inherit the property. So so if you want to transfer your real estate wealth to the next generation, or even beyond one generation, to your children and grandchildren, then it behooves you to hold your assets, real estate or otherwise, forever, right? Especially rental properties. If you have positive cash flow with your rental properties, I can't see any reason for you to sell a rental property which is earning you a positive return in terms of cash flow, right? Does it make sense? I'm sure it does. All right, so let's go on. All right, this is important things you need to learn on. So let's talk about your rental property. No, this is no. I'm sure actually this is a principal home. This, by the way, you can get a copy of this PowerPoint. Don't worry about it. All right. If you're unable to grasp the entirety of each slideshow, not only you can get a webinar replay of the entire presentation we're doing this evening, all 3 hours, whatever. In addition to that, you can get a PowerPoint presentation attached to the video replay that I will provide to each and every one of you. Furthermore, now there are several of you tonight that did not attend my regular buy out of state investment property part 1 and part 2 Monday and Tuesday night on behalf of Las Positas College. Unless you tell me otherwise, I have your email address, by the way. I have your email address. I'm going to put your your email into my newsletter database for my organization. So on a weekly basis, you're going to receive some sort of a information about real estate, free information, right? There's a lot of free educational content for my organization that if you give me an implied permission to put your email into my database. By the way, you will not receive any solicitation whatsoever for my organization. Okay, it's purely educational in general. Everybody in the world can log in to the email to receive our weekly newsletter through the email about various different type of real estate topics and opportunities and tax strategies and asset protection and investment opportunities, out of state markets. You can get all that information. No one gonna bombard you with follow-ups and bother you and those kind of things. So this is strictly educational information. Okay, so enough of that. All right, so okay, so this number pretty much validate what I just told you. You bought your principal home, right? And here are the over time, the property increased value. Then whatever your your gain, your initial gain, which is in this case 470,000, right? If you are when you sell your principal home, if you live at your home at least 2 out of the last 5 years, you can obtain this universal tax exclusion. If you're single, when you sell your property, you can only exclude up to 250K. The excess between 470, which is your profit minus your exclusion. If you're single, you have to pay capital gains tax. If you're married filing jointly, so you are able to exclude up to 500 grand. So this 470K of gross profit totally or under the threshold of 500K exclusion if you're married filing jointly. Therefore, you pay no capital gains tax when you sell your principal home. Okay. All right, I hope you understand. So, however, now many people in the Bay Area or in other places also, since I live in Bay Area, you guys most of you live in the Bay Area, right? So sometimes you can convert your principal home into a rental property, right? So let's say you've been living at your principal home for many years, and then you decide to move out and convert your principal home into a rental property. You have essentially recharacterized your home into a very completely different tax strategy. So if you live in your principal home for at least out of the last 5 years, then you move out physically and you rent it out to a bona fide tenant, and then if that tenant lived there for 2 years, so you hold the property as a rental for 2 years, then you could sell your property. Then it claims the tax deduction, which I will show you. And then if you were to sell that property as a rental property, you can be triggered capital gains, and then you may need to do some 1031 tax deferred exchange if you sell your rental property. As long as you replace the rental property with a replacement property within 90 days, and then within 45 days, identify the property within 45 days and consummate the transaction on a replacement property within 180 days. Then you would not pay any capital gains when you sell your rental property. We'll cover that a little more, okay, down the on this PowerPoint presentation. All right, so now from now on, we're going to talk about strictly rental property, no more principal home. All right, everybody get that? All right, so let's say you purchase your initial rental property for 100,000. That's what you call your original basis. Over the years, you have made some improvements to the property at a value of 20,000, right? And then you have to minus the $40,000 depreciation over the years that you claim equals your adjusted basis. Then when you sell the property for later for 250K, then you minus the adjusted basis of 80 grand. Then you'll have a trigger a capital gain of 170,000. Okay, so 170,000 now is a realized gain. Then you have to pay a recapture tax on all the depreciation that you created over the years. Yes, even though you claim depreciation over the years on your rental property, when you sell the rental property, you have to pay not only you have to pay the profit on the capital gain, you have to add the recapture. So you get kind of a double taxation. So therefore, your net profit could after taxes could be 140 grand subject to capital gains. Now, the good thing about it is we can talk about a 1031 tax-deferred exchange where you don't have to pay the capital gains. But okay, we are approaching the point whereby we can do a real-world example. So we are reaching to the in the areas of capital depreciation, which is one of the greatest tax benefit on the rental property is a paper loss, is a phantom deduction, if you will. So let me say this. So let's say now on the rental property, 270,000. Let's say today you bought a $270,000 property, rental property that is, all right. And let's calculate the first year depreciation. Now, in most properties, there's a land component which is not depreciable unless it is a condo or a townhouse whereby there's no backyard. Unless that's the case, most of your building, your structure that you purchased, there's a land component, the backyard or whatever, which is typically 20%. Okay, for the sake of discussion, 20% of your property is land. Since land itself is not depreciable, your tax person will usually deduct 20% of the property. So 20% multiplied by the purchase price is 270,000, right? Which is 54,000. So your basis is 216. 216,000 is a basis to calculate depreciation. All right. Now, so each property you own every year on any kind of investment property you own, there are less than 5 units, which is residential investment real estate. Your property gets depreciated over 27 and a half years. Okay, so 27 and a half, 216,000 divided by 27 and a half years. So each year on this particular property, you're able to deduct as a depreciation expense on your rental tax return, which we will cover momentarily, is $7,854. Does that make sense so far? So from a high level, the IRS, the way they give you the way they look at depreciation is such that when the IRS, in the infinite wisdom, anytime you own an investment asset, they place a expiration period. Okay, so depreciation, the pure definition, technical definition of depreciation in terms of the IRS, how they look at it, over time your asset will lose its intrinsic value. For example, your vehicle, your car, right? Your car really you truly lose value, right? It depreciates value because of the wear and tear, right? That asset. However, your house asset may not, due to wear and tear, loses value, but the IRS assign a X number of years whereby on paper your asset, in this case your property, your rental property, will lose its value. Well, at the end of 27 and a half years, your real estate physical asset, your single family home, for example, rental, will have no value, right? No intrinsic value. But however, on a historical basis, your real estate I mean, historically, long term always increases in value, which is great, right? So there's like very conflicting, offsetting extreme, right? The IRS deemed your property at the end of 27 and a half years have no paper intrinsic value, but in reality, if you buy a rental property in a good area, in a fast growing area, where you cash flow over time, historically speaking, real estate grows at 3 to 5% on an annual level. So essentially you can paper phantom deduction from the IRS, which is great, right? Which is great value for you. But this depreciation is pretty common, but there's some additional depreciation that many people are not worried about. It's called cost segregation, which I will discuss later, okay, which is the slideshow right here. But I'm going to kind of exit this PowerPoint and bring in two different form on the screen so I can go over the practical application of how to fill out a rental tax return. We can go over the depreciation. We can go over the regular depreciation versus the cost segregation depreciation method to determine the ultimately how much you have to pay the IRS on your taxes or your rental income on an annual basis. Okay, does it make sense? So let me exit this PowerPoint momentarily so I could go into my desktop and show you a property cash flow analysis and then a rental tax return. We can go over line by line item. Does that make sense? Line by line item. So I want to make sure, let me exit this, that you guys are still can hear me. So on my chat box, everybody confirm that you can hear me and you you can see the screen. You saw my PowerPoint. So far so good, right? All right. So nobody put down any additional questions about taxes. We can go over the your questions toward the back end of this training. All right. So I'm going to pull out this particular graph, which you saw before, right? Yeah. Okay. You have it. So everybody can see it, right? So can one of you or a couple of you just put it on your checkbox that you see this screenshot, this first year performance projection? Just say yes, I think you can. All right. So for those of you that attended my class, the two previous nights, you have seen this kind of a cash flow analysis, if you will, right? There's a reason why I'm going to discuss this. So what we're going to do is, okay, let me pull up my chat box for 1 second. Where's my chat box? Yeah, I want to keep my chat box open in case any text questions will accumulate for the next 1 hour. If I can get 10 to 15 text questions on the chat box, so towards the last 1 hour, I'm going to go over those your tax questions. All right, but okay, let me proceed. So momentarily, I'm going to show you a rental tax return. But before we do that, this cash flow analysis, let's pretend, okay, the first 2 nights, you learn a lot of theory behind, a lot of strategies and how to analyze a property, how to do research. So this is the third module, if you will. This is the third evening. Some of you, this is your third session. Some of you, if you're attending my session tonight for the first time, I'm so sorry. You may not see the sequence, what I'm trying to say. So let's pretend that you're ready to buy a property, okay? This is a real property, by the way. So I want to show you some real world application. I'm going to walk you through how to apply all the numbers, how to plug this number from this cash flow analysis into a rental tax return line by line item. Isn't that swell? Isn't that fascinating? Of course it is. All right. So So this is a, this the real property is in Lehigh Acres, Florida, which is one of the fast growing area. This is a duplex, by the way, $270,000 duplex. All right. So here, let's go over the numbers, right? The numbers are, you put 25% down payment, whatever it is, your 25% down payment plus closing costs is 73,000. This duplex, which is 2 doors, 2 separate unit, right? In this one structure, duplex, 270K. The combined 2 unit monthly rent is 2,600, right? Gross rent, right? Before deduction, right? And your annual rent, if everything, by the way, this is just a projection, all right? I mean, this is not reality, all right? But because we are in a training mode, so everything is assumptions and projections and hypotheticals and all that stuff, right? That's the only way we can talk about this training. So if your gross rent per month is 2,600 on both doors, right? Both sides, the 1,300 per rent per month per door, right? Per unit, if you will. So total 2,600. So if you multiply by 12 months, assuming this property gets rented throughout the entire 12 months on this tax year, 2020, so your monthly gross rent is 31,200 gross rent. Now hear me out, okay? Understand me real clear, okay? Pay attention. So this 31,000, theoretically speaking, let's say you're not going to claim any deduction whatsoever, not depreciation, not any other kind of deductions. But the IRS doesn't care. If you claim this 31,200 on this measly one property, this annual income that you receive, this passive income, if you do not claim any deduction, you know what? The IRS is going to feel okay with that. They don't mind you paying more taxes. So this 31,200, technically speaking, what I'm trying to say is subject to ordinary taxation. I'll say it again. Your profit coming out of your rental properties, your gross profit, is subject to ordinary taxation. What is the ordinary taxation tax bracket? I don't know. The lowest tax bracket, if you have a low income throughout the year, like 15% federal tax bracket. And then if you make, I don't know, 60 to 100 grand, your tax bracket could be like 20% marginal tax rate, right? If you make like 150 to 200,000 or more, you are probably in around 25% federal ordinary tax bracket. So depending on how much money you make, let's say you make you're making more than $250,000 W-2 income, husband and wife, for example, right? Married filing jointly, you're subject to 25% or 31% federal tax bracket. I'm not talking about state. Okay, I'm just talking about federal. Let's say 31% federal tax bracket because you're in a lot of money. This, technically speaking, this gross rent you receive on an annual basis, if you only report this, guess what? You have to pay 30% in taxes. 30% multiplied by 31,000, we talk about 10 grand. You have to write the IRS a check for $10,000. But you're a smart investor. Not only you attended this great class, but you later on you can consult your tax advisor when you file your tax return next year, 2021, for example. If you own this property and the number, the way it look, you need to reduce this 31 grand of gross annual income rent to as low as possible numbers in order to to pay less taxes, right? So we're gonna make this number 31 grand to the lowest possible number, the end result, subject to taxation. Maybe even pay no tax. What if you pay no taxes on this 31 grand? What if I can show you on tonight's presentation, you make 31 grand on this gross rental income on this great duplex in Southwest Florida, Lehigh Acres, brand new construction, and not pay taxes on it. That's one of the great tax benefits of owning rental real estate, and I will show you. Okay, now I'm gonna segue into the rental tax return momentarily. before we do that, you do have the underlying rental tax deductions. So just like a P&L, just like a profit and loss, just like income and expenses, you know, your gross income minus your expenses equals net income or net loss. So when you file rental tax return, it's same thing. Your gross rental income minus all the debt obligations minus your phantom depreciation expense equals your net income and net profit. If you have a net income on your rental tax return, that net income hopefully is a lot lower than 31 grand 200 will be subject to ordinary taxation. What if you have a paper loss? If you have a paper loss, not only you pay no ordinary taxes on your rental tax return, but you can have some further deduction. That loss, the paper loss, is what you call passive loss. Right? I'm going to show you based on your income level how much of the paper passive loss is subject to could be offset by earned income based on your income limitation. I'll go over that, right? So I'm gonna give you some heads up as to the power of a rental property. When people say, "Oh, when you buy rental real estate, not only you get the benefit of buying rental properties, or yeah, you get cash flow. Yes, you get equity appreciation. Yes, you get capital. I mean, mortgage deduction benefit. Yeah, you could pay down your loan. Your tenant going to pay down your loan, right? Over the next 30 years or less, right? And then there are tax benefit. When people say there are tax benefit, and I'm showing you the real tax benefit associated with owning rental real estate. All right. So all these are deductions. Your property taxes on this rental property, your property insurance, see, on this annual basis, are all plugged in. Okay. Okay. Later on, when I segue into the rental tax return, you will. I'm going to show you line by line item on the Schedule E Echo, otherwise known as rental tax return. We're going to plug this number on these expenses. We can apply all this legitimate deduction on all these rental expenses on an annual basis and reduce this 31 gross profit to the lowest number possible, subject to ordinary taxation. Even lower, we have a paper loss. That paper loss can further your paper loss, your passive loss, depending on your income limitation, can even make your money if that's possible. Okay, I'll explain much later. So your taxes, insurance, property management fee, repairs and maintenance, everything are deductible from the gross income of 31 grand annual gross. All right, does it make sense? So all these numbers is great. Cash flow here, by the way, this monthly cash flow is good, annual cash flow is very, very good. All the numbers looks good on this property, just so you know. All right, so okay, now I gave you some high level stuff. Now let's gonna go over the actual tax return, and hopefully, let me find it. Right here. Can everybody see this? Okay, so hopefully it's kind of dark. Can you see somewhat clearly on a line by line item? I don't know how else to make this bigger because it's a sort of a screenshot of the Schedule E supplemental income and loss, which is otherwise known as your rental tax return. Can a couple of you put on a chat box? Can you see this kind of a line by line item, like line 3, line 7, and line 9? Can you see all these expenses, advertising, insurance, and everything else? Can you say something? I know one person say yes, I can see it. Okay, good, thank you. I'll tell you what, let me take a 30-second break. I'll be right back. Okay, I need to drink some water. Hold on 1 second, I'll be right back. That's why. Okay, it's very, very hot, as you can tell, right here in Bay Area. 90 degrees where I am in the East Bay. Oh, by the way, you can take a break anytime you want, right? I don't know. You can do that, and you could, in fact, you can eat your dinner at the same time as you're watching this training. That's the beauty of, working out of your home nowadays. A lot of people, the new normal is that a lot of people would be working remotely. So I'm no different. So in a way, that's a good thing, right? I mean, you don't have to fight the traffic. Many of you moving forward, you don't have to fight the traffic, drive your car to go to work. A lot of companies, including the famous high-tech companies, as you know, in the Silicon Valley, they're going to allow you to work from home, uh, perhaps 50% of the time. So that's good. So the world is changing, so you have to adapt. So a lot of my future training will be online as well, but I would love to meet with investors. And typically, prior to this pandemic, we have the monthly live events, free live events in San Jose, where I get to meet my investors and we mingle. I always love human interactions, but for now, we can only do Zoom meeting for the future. But right now, to be honest, I'm trying to learn how to do Zoom meeting. In a few weeks, I'll be able to do Zoom meeting. You can see my face, everything else. But right now, this is the go-to webinar format. You cannot see my face, only my audio. Okay, all right, lot more training going on in the future. If you put it by email, a lot of free training. Free training. Hello. All right. See. Okay. On this rental tax return. So what we do, I cannot show you the cash flow analysis at the same time on my screenshot. I can only show you this rental tax return. So what I did was on this one property, as you can see, right? I'm gonna give you two scenario. Okay. What some of you are thinking? How come there are two property A and property B? Now, property A and property B on this duplex, this $270,000 duplex, is the same property. But I'm gonna give you a comparison. Okay, I'm gonna give you. Bear with me. This column A, we're going to do the usual regular depreciation write-off, the 27 and a half year, and then column B, we have a unique creative strategy. It's called cost segregation, where you can claim more depreciation, and you will see the dramatic result using regular depreciation versus using the accelerated depreciation, which is the cost segregation. Some of you know what I'm talking about. Most of you do not, but just hang in there. You're gonna get the bottom line. Let's go over line item by line item. So as you know, the same annual gross rental is 31 grand, which is quite high for only one property. Imagine you buy multiple properties like this. If you have the money to do so, you could have a very high gross rent on multiple properties, and then you can use creative tax strategies to pay as little money as possible. Unless you buy investment property using your self-directed IRA, then you pay no taxes on your rental income and equity appreciation. And when you sell your property, you pay no capital gains either if you buy your rental property using your IRA, which we discussed that last night. Okay, so anyway, so okay, 31 grand, 200 annual gross profit. So you can deduct the annual. Let's pretend you have like 5% maintenance costs, right? You have to incur $1,500 on an annual basis for cleaning and maintenance, right? You can have some, repair and maintenance, but on a new construction, as in this case, on this duplex, it's pretty reasonable to have $1,500 of unforeseen cleaning and maintenance. Uh, Pretty realistic. So this is deductible, right? Because it's any kind of expenses that are that derive from ordinary necessary expenses. Any kind of expenses on your rental property, which are ordinary and necessary. This is a tax definition, or deductible against the gross profit. So as you can see, each of the deduction will further reduce your gross profit. So you have a net profit or net loss. That's what you want. You want a net profit and net loss, at least on paper. Okay, let's go on. So then the next deduction, all these numbers I plugged out from that property analysis, the pro forma, the cash flow analysis you just saw on the previous screenshot. Okay, so the insurance, the monthly property insurance you're paying, well, this is annual. The monthly is whatever, $40 a month. Annual $720. Okay, and then your property management fee are also ordinary and necessary expense associated with your rental property. So your annual property property fee that you pay, which is 8% of your rent. So annually equals 2,376. All right, and then the mortgage interest, right? You pay, you purchase a property at 25% down payment. You got a loan for 75% loan to value. So the the monthly cost of your loan is like about $1,000. So the mortgage payment is also ordinary and necessary expenses. So on an annual basis, you can reduce your gross profit by the cost of the mortgage on an annual basis, which is $12,000. And then all these are routine expenses, right? And then your property taxes, not this insurance, your property taxes on an annual basis is 2,300. So which is good, right? Because the property itself is 270,000, right? If your annual property taxes on this subject property is only 2,300, guess what? Your property tax rate is less than 1%. Anytime you buy a rental property and the property tax rate is less than 1%, that is a very good number. So buy in Florida, everything, all the numbers really good. It's a very good market. But less than 1% tax rate is very, very good. Okay. Okay, then here's the nitty gritty. This is the value of what you're going to get by, in fact, this particular strategy, this depreciation, this passive loss limitation, if you learn nothing else from this, from tonight, the money that you pay to attend this loss proceedings class is well worth it just by learning this one thing, this depreciation, otherwise known as passive loss limitation. I will go back to the PowerPoint momentarily, but so if you use, as I mentioned earlier, the regular depreciation on this property is your purchase price minus 20% land, which is not depreciable, equals your adjusted basis. So adjusted basis in this case is 216,000, okay? Because you minus land. 216,000 divided by 27.5 years depreciation method. Your annual depreciation is 7,854, right? We all agree on that. So therefore, when you add up all these number, the expenses from line 5 to line 19, so your total expenses is 24,445, right? You add up 7,854, add up 2,300, add up 12,000, 2,371, 720, 1,500. Okay, so your total is 24,445, right? So 31,200 gross rental income for the year minus your gross, minus your ordinary and necessary expenses for the whole year, which is 24 grand. 31,200 minus 24 grand for 45 equal net profit of $6,755. So would you rather pay your ordinary taxation on a 31 grand, as I talked about earlier, or would you rather pay taxes on a gain of only 6,700? So I reduced your gross profit of 31 grand to 6,755. So we're talking like we'd reduce your net profit subject to ordinary taxation fivefold. Did I say it right? Fivefold, right? 6 divided by 31 is 5, the multiple of 5. So you pay, if you're in the tax bracket of 20%, right? Federal tax bracket, 20% multiplied by 6,755, You're only going to pay tax for 1,200. You only pay tax for 1,200 on your tax return net on a gross earning of 31 grand, right? You win. You win in the real game of real estate and the tax game of real estate. Okay, so this 6755 will normally be under here, line 28, right? Total rental income. Line 28, which is same as line 21, 6755. This net profit 6755 will go to your federal 1040, right? The first page of 1040, and this will be on the first page of 1040 for your federal tax return. This 6755 will be included in your first page, which is similar to your W-2 income on your first page, subject to ordinary taxation, right? Now, the beauty of the creative tax strategy I'm going to share with you, which many investors experience or otherwise, they do not understand this new tax rule, cost segregation. Cost segregation is called accelerated depreciation. Do you understand what I'm saying? Okay. So I know I'm going to give you a final number. I'm going to show you how this 22,254 came about. I'll say it again. By using accelerated depreciation, instead of getting a paper depreciation loss of 7854, you're getting a whopping paper loss of 22,254 by using cost segregation. Okay, I'll give you the end result first, then I'm going to go back to the PowerPoint to show you how I calculate this 22,254. Don't you want to know how I came up with this number? Of course you do. This is important. This is significant. This is astronomical. Astronomical. This is significant. What else? Anyway. Oh my goodness. So your paper loss of 22 grand plus your other expenses, right? That, equal your net ordinary and necessary expenses, including your $22,000 of depreciation, equal 41,145. So your gross rental annual income is 31,200 minus legitimate expenses of 41,145 equal, you have a net loss, at least on paper, of almost 10 grand, 9945. This 9945 will be carried forward into line 28. This will be your net income from your real estate transaction. So this have some additional benefit, which I'll show you later momentarily on a PowerPoint presentation. You can get some tax benefit for this. So think about it. Think about this. You make so much money on your real income, on your day-to-day management, and of your rental property. In this case, this duplex trigger you so much real money in your pocket, real money inside your pocket. But in reality, because you're so good with taxes, you are putting more money in your pocket. So when they say tax benefit, this is really true. You essentially pay no taxes on this 31,000 grand of what the rental income your tenant is paying you throughout the year. Wow. Okay. Everybody get that? Okay. Here's the nitty gritty. Let me transition back to the PowerPoint. Right here we are. All right. Let me minimize this control panel so I can enlarge this PowerPoint. All right, so here's the cost segregation. Everybody can see me, right? I cannot see your chat box anymore because I minimized the control panel. I assume you can see this slideshow. Okay, on the previous slideshow, we discussed the regular depreciation. We have depreciated the entire building, the entire structure, just lump the entire structure over 27.5 years. That's why you're getting $7,854 of depreciation for the year, right? But now we're using cost segregation. Okay, let's break it down. Okay, hopefully you understand. If not, the webinar replay, you can play it more than once or twice. You may get it. The light bulb may finally hit you after repetition on a webinar replay, which the video you're gonna get probably tomorrow morning. Okay, so cost segregation. So regular structure. This 216, you know where it come from, right? It come from 270K of your original basis, original purchase price minus 20% of land, which is not deductible. The 20% land is 54,000. So 54,000 reduced by $270,000 equal 216, right? Right, 216. So you're getting this. That's fine, right? Plus, you can under cost segregation, you could the land is the expiration, the recovery period, the expiration period of a life of the asset of the land is depreciable over 15 years. See, we're doing accelerated depreciation based on the IRS rules and regulation. A land is depreciable over 15 years because for whatever reason. Okay, okay. So 15 years divided by 54,000, right? That's a land component. So on an annual basis, you can write off depreciation expense on 3,600. So you have 54 already on the straight line, 27.5 depreciation plus 3,600 on the land. Then personal. What I mean by personal is like 5-year depreciation, 7-year, 10-year. You know what's personal? Personal items. You know the earlier slideshow that we discussed. In fact, let's what I mean by personal. So let's go back to the earlier slideshow. Hold on. Remember the laundry list of items we went over right here. Okay, there's 2 slides. Okay, new roof, new floor, new windows. New roof could be like a 10-year depreciation period, recovery period. Windows probably 5-year. Doors maybe 5 years. Skylights rewiring maybe 7-year recovery period. Outlets, jacks 5-year. You know what I mean? And then wash and dryer is a 5-year accelerated depreciation. Cabinets, dishwasher, refrigerators 5 years, maybe 7 years. Okay, but you get the idea. So any items inside the property that are not permanently affixed to the foundation of the property is subject to a can be itemized and can be created and categorized under a shorter depreciation method, under a accelerated depreciation method. You understand what I'm saying? Anything that are not, the things that are not affixed to the foundation of the property, or a furnace, electrical system, and all this typical stuff, washer and dryer, and what else? The cabinets, the boiler, the heater, the outside landscaping, right? The backyard, lanai, and the front yard landscaping, they are not part of the permanent structure of a building. Does that make sense? If that's the case, you could kind of plug it out and create do a cost segregation. By the way, you need a organization or even an accountant that specializes in cost segregation. You may have to pay, I don't know how much, depending on the size of your property. You need a sort of a official addendum when you file your tax return to show how did you come up with this cost segregation amount. Does that make sense? Or maybe, no, I don't know, you have to talk to your tax advisor. But as long as you have supporting documentation, as long as you have a third-party verification that did the cost segregation for you, so you have to pay an extra amount of money. I don't know how much. There are companies out there. I know who they are. I mean, I have some sources I can refer. Not all, by the way, not all certified public accountants know about cost segregation, right? Not all tax advisors out there, or licensed tax advisor, or not all licensed tax attorneys understand cost segregation. They may not even understand depreciation. Okay, you have to find a consultant or tax person that specializes in cost segregation, and you pay that person accordingly. You pay that organization accordingly to come up with this plan. So if you buy a property, a very cheap property for 50,000 or something like that, or even 75,000, you know, you may not, you may not, you may not be, I don't know how you say it, justifiable to pay somebody $500, a cost segregation consultant, 500 or even $1,000 just to get some small benefit. But on a property or larger, as in this case, $270,000 property, yeah, it may, the cost benefit analysis, the cost of paying to do the cost segregation, uh, you will achieve the tax benefit. Okay, you know what I'm saying? All right, so let's go to the calculation. So we've done two calculations, and then we have determined that a whole bunch of 5-year appreciation items. So let's say, up to 270,000 of it, 20% of the item or personal items that can be itemized under the 5-year depreciation. Okay, so $270,000 of it, 20% of those items are, which is 54,000, can be depreciated over 5 years, accelerated. So 54,000 divided by 5 equals additional 10,800. Does that make sense? I mean, you kind of get the idea. Again, this calculation on this PowerPoint is not official. This is just a educational session, right? Consult your tax advisor to go over your unique situation. Okay, this is just a general training. All right, so you combine 7854, 3600, and 10,800. Bam, you have a total of $22,000 of $264,000 depreciation using this cost segregation method. Does that make sense? Okay, now we talked about you have almost $10,000 of loss, right, on the rental tax return using cost segregation. So let's determine how much of that $9,954, I think, of the paper loss using the cost seg strategy, you can offset against your earned income. So here it is. Here are the passive loss limitations. If your adjusted gross income (AGI) is $100,000 or less, you may deduct up to $25,000 of rental losses against earned and portfolio income if you actively participate in the management of the property. Actively participate is a very, very easy rule to qualify. Even if you have a property manager doing most of the managing of your out-of-state property, for example, the mere fact that you gave one instruction to the property manager. So this active participation rule is very easy to qualify. That means even though your rental property you bought out of state, for example, is totally passive, meaning you are delegating your property management to do everything for you. All you have to do is to document one activity. For example, you just even a verbal or written acknowledgement that you agree that you concur with the property management or tenant that they accepted. Just by one little action throughout that tax year, you are deemed active participant rule. So the active participant rule is very easy to meet. Okay, so as opposed to, we can talk about like a material participation rule. The material participation rule is much more stringent for a real estate investor. I will talk about more about that in the next few slides. Understand? So with that in mind, if you make 100 grand or less, you can deduct up to a maximum of $25,000 passive losses. Okay, I know most of you live in Bay Area, unless you are, if you marry filing jointly, if only one spouse is working, even that spouse make more than 100 grand in the Bay Area, right? I mean, everybody's earning so much money here in Silicon Valley. But let's assume that whether you're, you marry filing jointly, you make less than 100 grand of your income, W-2 income, you could deduct up to 25 grand. In this actual case, you're deducting 9,954, right? That 9,954 will be carried forward to the first page of the federal tax return, can reduce against your earned income. That's a very high value reduction. So that 9,954, if you're in a 25% federal tax bracket, do the math. 25% federal tax bracket multiplied by 9,954, let's say 10 grand. Okay, 10 grand multiplied by 25 percent tax bracket, which is like what, 2,500. That 2,500 is a real tax deduction. Is a tax liability deduction, very significant. Does it make sense? Now, if you make more than 100 grand. Oh, by the way, if you have like one property using cost seg, the duplex, we talk about 270K duplex. If you were able to buy like 2 or more of those properties I just went over, and you use a cost segregation strategy, you're gonna at least reaching the threshold or even exceed the $25,000 of a passive loss, right? So let's say you own 4 or 5 to 6 rental property, and each rental property you use a cost segregation strategy, you're gonna have more than 25 grand of passive losses, right? So if you make less than 100 grand, if you have more than $25,000 passive losses, you can claim the $25,000 on the current tax year to offset against your income. So for example, if you're able to achieve, for example, $25,000 passive losses for this current year, and you truly make 100 grand, you're not paying ordinary taxation on 100 grand. You're paying ordinary taxation on 75,000. 100 grand minus 25,000 equals 75,000. That's a very significant tax deduction, right? So if your passive losses is more than 25,000, if you paper loss in any given year, if you make 100 grand or less, you could anything excess of 25 grand or carry forward to the future tax year. Okay. And in the future tax year, if you're in a future tax year, if you couldn't claim any of those passive losses deduction in the future tax year, those passive losses will be automatically pushed forward, suspended into the following year. So if you accumulated a lot of passive losses, which you couldn't claim on the current tax year, over the next 7 to 10 years, let's say you have accumulated $100,000 of passive losses because you own 3, 4, 5 rental properties and you make less than 100 grand, right? You have a whole bunch of like 100 grand of rental passive losses, right? In 10 years from now. Let's say if you were to sell your property and you have triggered a capital gain of 100 grand, something like that, right? All that years of suspension of passive losses can be offset against the capital gain if you were to sell this one of your rental property for 100 grand. So therefore, you can pay no capital gains. If you sell your future rental property and you trigger a $100,000 capital gains, and you have $100,000 of suspended carry forward capital of passive losses around 100 grand, right? You know what I'm saying? That means you pay no capital because all the passive losses have a future value if you were to sell some rental properties. Therefore, You don't need to do a 1031 tax deferred exchange because you have so much suspended passive losses to offset against your capital gain if you were to sell your rental property. Am I talking too fast? Do you understand what I just said? I think you do. All right. What if your adjusted gross income, what if your W-2 income essentially, or is greater than 100 grand, but less than 150,000? There's a phase-out deduction. I'm not going to go over it. It's kind of complicated. So when you reach a threshold of more than, if you make $150,000 or more, and here's a chart. Okay, if you make less than 100 grand, you can deduct up to 25 grand, right? This is passive loss limitation. If you make between 100,000 to 150, then you're gonna have a offsetting. For every $1 you make above 25, above 100,000, there's a phase out. When you reach the level of 150,000, the phase out is over. That means you make $150,000 or more, any of the paper loss, the passive loss, in this example of this property, 9,954, you cannot offset that against your earned income in that tax year, in this current tax year. Everything will be suspended. You will get no current year deduction on those paper passive losses if you make more than 150,000, right? So everything will be suspended. Okay, any paper loss negative you achieve for the current year will be suspended because you made into the future years because you made more than 150 grand. So in the future year, if you happen to make less than 100 grand, right, for whatever reason, or if you were to sell your rental property, you can get some tax benefit. You can use those suspension of passive losses on any given future on a year-to-year basis, depending on your income situation, right? So just because you cannot claim any paper loss on the current year because you make too much money, you make more than 150K, which is not hard to do in Silicon Valley, right? Don't worry about that. The suspension of those paper losses carry forward to the future year is still a tax benefit. Don't complain that you cannot get a current year deduction because you make so much money. So the suspension of passive losses is a future tax benefit no matter how you look at it. Okay. Everybody clear? I think so. All right, what time is it? All right, 7:30. So we are halfway through, right? All right, so, all right, now this next rule I'm going to share with you, I have to say it that not many of you may qualify. Some of you may. We'll discuss this. It's going to be a little bit dry, so I'll do my best to explain this. So, you see this title, Become or Marry, quote, Real Estate Professional, end quote. By the way, the IRS definition real estate professional is not what you think. It's not practical. It does not mean you have to become a licensed realtor to become a real estate professional. The real estate professional is a very technical term, is a sort of a material participation rule. Before, mostly all the rental property owners out there, if you own a rental property, if you do not use a third-party property manager, you're self-managing your property, you can probably meet the material participation rule and you may be able to become a real estate professional. But the rest of you, nothing wrong with delegating all your artistic property and managed by a property manager. You can still get all the deduction because you are a active participant status. But you can change the status. If you want to become a real estate professional, you can. Theoretically speaking, if you're able to qualify, you can achieve even more deductions, way more. But be careful, this could be a red flag because this is an audit situation with the IRS in the past. But again, you need to consult your tax advisor to determine whether you qualify to become a real estate professional or not. What does it take? What are the rules? If you qualify, You must document, and consult your tax advisor to make sure that you are audit proof, if you will, from the IRS, right? Does that make sense? Okay, so here it is. If you could become a risk professional or marry one, I know you have no idea what I'm trying to say. What Mr. You trying to say? Marry a risk professional or become a risk professional? Okay, I'll hold your thought. I will explain momentarily. If you have the ability to become the tax definition of risk professional, you can deduct unlimited real estate losses against unlimited earned income, no limitation, no restriction. Understand what I'm saying? So anyway, it's not easy, all right? So in order to become a professional, you must be able to document 750 hours of material participation activity. If you're able to do so, as I told you, you can deduct unlimited passive losses against earned income, regardless of your status. Does that make sense? Step to qualify. Okay, I'm gonna give you some very technical definition, but then I'm gonna give you some practical verbal definition, which you can understand what I'm trying to say. The technical definition to become a professional is like step one is one spouse alone must qualify. Okay. Step two, you must pass the test. You must document the management of 750 hours for the year, and 50% of your total work time have to be done in a material participation rule on this rule, 750 hours. 750 hours divided by 52 weeks, we're talking 15 hours per week of real estate hours, activity hours. You know what I mean? Okay, let me make it simple for you. Let me make it simple for you. In order to the ideal way to qualify to become a real estate professional, and again, you don't have to be a licensed realtor, by the way, although you could be, but being a licensed realtor, part-time or full-time or otherwise, it may make your status less of a audit risk from the IRS, if you will. Okay. Anyway, so the ideal situation is, by the way, if you're single, by the way, if you're single, it does not matter how much money you make, you most likely you do not qualify to be a risk professional, because you're not going to meet this rule right here. 50% of the time must be in the real estate activities. How could you work full time, 40 hours a week or more, and still able to accumulate 750 hours uh, uh, per year? I know some of you are thinking, whoa, 50 hours divided by 52 weeks is only 15 hours. Yeah, I can put in 40 hours of regular full-time job plus 15 hours per week, which equal 55 hours. No, that's not how you calculate. That's not how you get around the rules. I don't know how to explain it anyway, but if you have a regular job, if you're single, if you work 40 hours, you must meet this rule, 50% of the total work time. If you are single, if you work 40 hours, you have to work another 40 hours in the real estate activity hours. For all intents and purposes, you're not going to qualify. Okay? If you're single, you cannot qualify to become a real estate professional because you're already working 40 hours. You're not going to meet the 750-hour rule. Trust me, okay? I don't know how to explain that to you. So the best way to do a real estate professional scenario, I cut to the chase, is you are married filing jointly. You, as one spouse, making very significant income, way more than 100 grand, way more than 150 grand, like $200,000. Because if you make $200,000 W-2 income as a working spouse, you are subject to 31% tax bracket, most likely. That's an ideal scenario for your non-working spouse to become a real estate professional and do the 750 hours per year with full documentation, which is 15 hours per week. So the non-working, or I could even say part-time, your spouse, ideally, they qualify to become a professional, doesn't can work part-time on some other job. That's fine, 15, 20 hours per week. That's max, and still be able to qualify for the 750 hours. Okay, so ideally, the spouse is a non-working spouse. That's even ideal. So all he or she has to do is to meet this rule, 750 hours per year, which is 15 hours per week. All right. So in order to get more than 25,000 passive losses, you can have to own a lot of properties. You just cannot be a real estate professional right off the bat, right? You have to own, like, when you own 5 or 6 or even 7 rental properties or more, that situation may be ideal for you to look into to become a real estate professional status. By the way, another challenge that you're facing from the real world application of it, if all of your properties are being managed by a property manager, you are really not materially participating in the hours. I say it again, if all of your properties, 5, 6, 7 rental properties, even if you qualify for the core segregation, married filing jointly, to become a real estate professional, since all of your properties are managed by a full-time property manager out of state, you're not a material participant. There's nothing for you to do. Okay, you can't attend seminars and claim those hours because your material participation hours are based on very established definition. Okay, let me tell you what are those definitions. Those 750 hours per year, 15 hours per week. The documentation are the following: develop, redevelop, meeting engineers, architect, planners, construction crew, financial professionals, hiring, supervising, construction work, demolition, rehabbing, meeting with salespeople, searching for property, preparing, offering, right? These are very, you are do-it-yourselfer. You cannot hire a third-party property manager. All right, so you have to manage all your property. You are the do-it-yourself property manager to document all this, to meet the material participation requirement. Does it make sense? So that's why most of you forget it. Forget about becoming a real estate professional. There's a lot of rules you have to meet. Okay, plus it's a high audit risk by the IRS. But the ideal situation, once again, I'll say this and I will conclude this rule. If your working spouse makes a lot of money, $200,000, $300,000 W-2 income, if you own 4 or 5 rental property, and if you use a cost segregation strategy on all your rental properties, as I show you, then you're going to have way more than 25 grand passive losses, even if in reality you're making tremendous amount of cash flow income, right? And then the non-working spouse or the part-time spouse will document all these hours. And then let's say you have 5 or 6, 7 rental properties, right? If each rental property give you like 10 grand of passive losses, in the case of on an example which I've shown you, let's do the math. 10 grand of passive losses per property per year. If you own 7 properties, 270K each, 7 duplexes, for example, 7 multiplied by 10 grand of passive losses equals 70,000. That's $70,000 of passive losses. If you are if you are a real estate professional, that's 70 grand. If you do the hours, if you document, you can fully account for all the correspondent log, documenting everything you do for the entire year. You qualify as a financial real estate professional. That 70 grand of passive losses can offset your working spouse of 200 grand of income. So your working spouse, 20 grand income, instead of being taxed at you know, from $200,000 earning, the 200,000 minus the 70K of passive losses. So instead of 200 grand of W2 income, you get 20,000 minus 70, which is 130. So your working spouse would be taxed at 130K instead of tax at 200K. See the significant benefit associated with become a real estate professional. Okay, now you got it. All right, let's move on. Any questions? Okay, let me see. These are material participation rule. It's much more technical than this, right? I mean, there's a lot of technical mumbo jumbo. I'm not going to discuss that. You have to make a group election. You have to do this. You have to do that. Okay, let me see what else I need to show you on this PowerPoint. As I already told you, you are by definition an active real estate investor by virtue of owning a property managed by a property manager, which is fine. Continue what you're doing. Okay, let me see what else. Okay, let's talk about, before we talk about section 1031, some of you can take a break or eat your dinner and watch my presentation at the same time. Let me see what kind of questions you have. Anybody have any questions? Yeah, let's take a quick Q&A. All right. Can we still take a depreciation on rental property if we have AGI 150K or less than 150K? The question is, can we still take depreciation on rental income if we have adjusted gross income of more than 150,000? No, right? If you follow the rule, if you make more than 150,000, all your paper loss will be suspended, will be carried forward indefinitely to the future tax year on a year-to-year basis. Okay? Did I answer your question, Ram? So you have to make less than 100 grand in order to claim deduction up to 25 grand per year on the passive losses. Okay, another question from Mei Chan. How do I know the breakdown cost of land versus structured building? Price on Zillow does not break this out. Of course not. How do you know? It's not an exact science. Good question. One way to know is your licensed tax advisor should be able to determine you can determine by looking at the I think the local tax records, right? I mean, when you own a property, you can look at the county where your property is located. And I don't know the details of it. By maybe online, you can search the address of your property, and the county records may have a breakdown of what portion of the property is land component, maybe is not. But absent that, it's not a precise science. I think most of the accountant out there, most of the tax advisor out there, they will most likely do a arbitrary 20%. It's a standard situation. 20% is land component, unless it's a condo or a townhouse when there's no land, right? Does it make sense? Again. All right, come on, I need more questions. Okay, maybe there's more. Is the personal depreciation only for new construction? No. The minute you close escrow on the property, whatever is the purchase price, that established the basis of the property. The word basis, right, is important. It's a tax definition. The word basis, B-A-S-I-S, is the triggering thing. It's a foundation that can calculate depreciation. Okay, your basis. So whether you buy a new property or old property, whatever is the initial purchase price, that is the basis number to calculate the depreciation. Does that make sense? All right. So anybody else want to type some more questions? No. All right. So right now it's 7:45. I'm gonna cover 1031 exchange for the next 15 minutes or maybe longer if you have a question. Can somebody see this partial PowerPoint? I mean, okay, let me enlarge it just so you guys. Anybody can still see everything, right? Okay, let me enlarge this slide deck. Okay, Section 1031 tax deferred exchange. Anybody heard of it? Now, you know, early example, right? If you are, let's pretend we're not talking about passive losses. Let's pretend we're not talking about anything. Whenever you sell any kind of asset, not just real estate, right? When you buy a real estate for, you know, investment property for 100 grand, right? Then when you sell it a few years later for 150,000, so you have a gain, right, of 50,000. Does it make sense? So that 50,000 will be subject to capital gains tax, let's say 15%, right? 50% multiply the gross profit. So you have to pay like $15,000 capital gains on a straight out sale. And don't get me wrong, a lot of people over the years, they sell their property for whatever reason, right? And they're not going to become an investor any longer. They're just going to pay their taxes and move on with life. They don't want to become a real estate investor anymore, right? So the 1031 tax free exchange, well, is not a, you know, the primary motivation of doing tax free exchange is not taxes, is a life situation, is a personal goal, and objective. What I'm trying to say is, if you sell your asset, in this case, your rental property, if you do not want to pay a capital gain on it, you could buy a replacement property and close escrow within 180 days, and then your capital gain is deferred. Your capital gain is deferred until the future occurrence. All right. Okay, there are more, more rules than that. And I mean, once you, if you want to do a 1030, so why would you want to do a 1031 tax free exchange? Okay, I mean, I'm not talking about taxes. The reason why you want to do a 1031 tax free exchange, like a lot of people in the Bay Area, right, that have a rental property that they own for the past 20 years or for the past 10 years, and the property have grown in value so much, right, that we have experienced, especially from the year 2008 or 2009, right after the recession, from 2009 until now. Especially Bay Area, the appreciation is so great, but the cash flow is very, very low, right? We know that. That's why most people do not buy rental properties these days in the Bay Area, because the numbers are not right, because the rent does not match the value of the property. You're not gonna get a cash flow. You're not gonna cash flow. But that's why I've seen many, even my investors in the past few years, they have done tax-free exchange. They're getting negative cash flow from their current rental property in the Bay Area. They have tremendous amount of equity. So they want to do a 1031 exchange. They sell their high equity rental property in the Bay Area with no negative cash flow, and they do a 1031. They exchange for like 10 out-of-state rental properties, right? So that 10 out-of-state rental property will give them tremendous amount of cash flow, so they can retire or whatever, with a passive income. They can. So that's how they, that's the one good reason of doing 1031 taxable exchange, right? Um, but if you own a rental property, they'll give you nice cash flow. Why sell? Because you're making money already, right? For your foreseeable future. So anyway, so that's the reason. If you wanna, for example, another reason why if you own a single family home rental, you wanna buy a whole bunch of commercial property or a fourplex, you wanna buy a land, you wanna do some other kind of exchange replacement property. Those are another good reason why, right? So it's not only about taxes. So when you sell your rental property to trigger a 1031 taxable exchange, you have to identify the replacement property within 45 days, right? Okay. Then within 180 days, which is 6 months, the replacement property must close escrow before the 180 days deadline. If the deadline, if you exceed the deadline 180 days, then you have to pay capital gains tax. You cannot do the so you must meet the deadline. The deadline is critical, so you have to work with a 1031 intermediary company, exchange company, to help you facilitate the transaction. You have to consult with your tax advisor or your financial advisor to ensure that you're doing 1031 taxable exchange for the right reasons. Am I right or am I wrong? All right, I'm right. Right, so any questions so far? So the benefit of exchange, right? You can preservation of your equity, your leverage. Now, if you qualify for the loan, to get investment loan, that's ideal. You can, because you could the benefit of taxable exchange, preservation of equity, deferment of capital gains, right? Leverage, you can exchange for more valuable property, increase return on your replacement property. Diversification, acquire properties in other states and other cities, acquire different property types, right? Exchange one property to another one to easy to manage, right? Estate planning purposes. All these are good reasons to do a 1031 exchange. So you could exchange a single family into a duplex. You can exchange land into an apartment, right? So although it's called like kind exchange, really is not like kind exchange. You can do different type of asset class replacement property as long as income producing to income producing. You cannot do a 1031 on a principal home that you live in there for your entire life. Again, so because your principal home is not a investment property, principal home is that simple. But if you want to convert your principal home into a rental property, then do a 1031 later, you can do that. A lot of Bay Area people have done that. What I mean by that is, let's say you live with your principal home in Bay Area, and then you have so much equity of your home, even if you sell the principal home, even with the universal tax exclusion of 500 grand, you still have more equity beyond the 500 grand universal tax exclusion, which I covered earlier, right? Let's say, what if you bought a property for $100,000 in the Bay Area 30 years ago, and that property increased in value to $2 million today, right? If you sell the property the way it is, even with a 500 grand of a universal tax exclusion, you still have to pay capital gain tax for the remainder, for the which is quite significant, right? Clearly. So how you not pay any kind of capital gains tax? Well, what you do is you have to meet the two out of the last 5-year rule. So you must rent the house out for at least 2 years out of the last 5 years. So let me give you a better example. You move out of your principal home, which is worth $2 million today, right? If you bought it original cost basis for 100 grand, whatever, 30 years ago, right? If you, the best way to do it is to move out your physically move out, rent out your rental property for 2 years, at least 2 years, to meet the, to meet the safe harbor rule. At the end of 2 years, kick the renter out. You meet the 2 year, 24 months rule because you have recharacterized your owner occupied property into rental property for the remaining 24 months. Have a renter living there, kick them out, then sell the rental property and do a 1031 tax-free exchange, buy out of state property, get financing. Finance, you could exchange to like 20 different property out of state, for example, right? And meet the rule, identify the property within 45 days, close escrow within 180 days. Then all that $1.5 million of profit of capital gains, you don't have to pay because you did a 1031. You see what I'm talking about? Pretty simple explanation, isn't it? Yep. Then you retire with multiple property managed by an outside property manager and still deem yourself a passive investor. And at that time, if you want to, you can do the married filing jointly status if you want to, but you don't have to. You should not. You just retire into the sunset, having 10 to 20 property will cash flow amazingly in Florida, Texas, or in the Midwest. So that's how you diversify. Best way. Okay. So I don't think I'm gonna talk anymore about it. What time is it right now? We are 1 hour away. As I told you, the last 1 hour of tonight's presentation should be Q&A. So I'm going to minimize this PowerPoint, and then I'm going to open up my control panel, and I better see a whole bunch of questions. Otherwise, if you do not have enough questions between now and 9 o'clock, right now is 1 hour left. Right now it's almost 8 o'clock. From 9 o'clock, we may have to leave early. We may have to conclude this presentation early. So ask me any real estate tax question. This is another value that you need to get. Ask me any questions, not just taxes. All right, this is your chance. Otherwise, you know what I mean? All right, come on, I'm waiting. Okay, I may have, no, hold on. Okay, some of you might be leaving early, which is fine. There are like 7 of you left, I think. So what should we do? You know what? You know what I'm gonna do? I'm going to enter Zillow. Let's go through something. So you guys still see my screen, right? So let's identify certain real estate markets. All right, let's. Okay, let me find a property for you. Let's. All right, there's some questions. Okay, there's some questions on the chat box. Okay, good. All right. Yep. By the way, we could after we conclude this presentation, you know, you are on your own, and if you any one of you want to contact me any one of you want to take some initiative, you may contact me and we can go over one-on-one situation. But right now, because I'm speaking on behalf of Las Positas College, I cannot talk about my personal services, right? About what I do. So everything I'm teaching you is all educational purposes, is for you to gain the power of the information I share with you and go out there on your own and find your own resources. But for those of you, you should have my phone number and email address. You can contact me. I'm not going to reach out to you, right? I do not do any solicitation, which without any advance permission. You have to come to me, for example. I'd be more than happy to consult with you one-on-one situation to go over your goals and objectives. That's all I have to say. I cannot promote my services. This is the protocol I have with the school, and I'm sure you understand, right? So, okay, okay, there are several questions. What are the tax implications when the rental property is owned by an LLC? Okay, good question. What are the tax implications when a particular rental property is owned by the limited liability company, also known as LLC, right? LLC. So the IRS will deem a LLC as a disregarded entity, quote unquote, disregarded entity. The mere fact that you hold the property under LLC does not absorb you the obligation to, you still need to disclose your rental property income and losses for tax purposes. So yeah, when you hold property under LLC, the LLC is the primary goal of the LLC is for asset protection. This means your property cannot be found in the public records because the LLC is holding the title. They cannot find you. That's the idea, right? But for tax purposes, the LLC is a disregarded entity. You still have to file the rental tax return, the Schedule E, as I uh, uh, discussed this evening. Did I answer your question? I think so. Again, I have a disclaimer. I'm not a practicing licensed tax advisor. I'm not giving you tax advice. This is a general information purposes only, right? That is my disclaimer. So do not go and run and do your own thing just because I say this, I say that, all right? All right, a few more questions. That's great. Awesome, awesome. Can expenses for traveling to see the artistic property be used as a deduction? That's a very good question. As a matter of fact, uh, my PowerPoint have a slideshow to talk about that. In fact, I'll get back to that. Let me answer some other questions and see how it goes. Let's do Austin, Texas. Okay, I will do it Austin, Texas strategy for you momentarily. All right. Then let me find another question. One question is what's new 2019 California rental cap impact? How does it apply to rental property? What's new 2019 California rental cap impact? I do not understand the question. Can you rephrase the question a little bit, Haijing? What new 2019 California rent cap? Don't know what you mean by that. But let's go over. Okay, let's go over the travel deduction scenario, which I have it on my PowerPoint actually. Where is it at? Okay, okay. Let me find that slideshow on here. Bear with me. Here it is, okay? Here's the flow chart for travel to rental properties. I'll be real quick. And by the way, you're gonna have this PowerPoint. I will email this to you along with the webinar replay. So I'll be real quick. Now, this flow chart basically tells you travel expenses. If you before you buy a property, if you can travel out of state, for example, or doesn't even have to be out of state. Could be a few hundred miles away somewhere, right? Uh, if you incur expenses that are related to travel to look at the property before you buy, right? Then when you come back later and you decided not to buy that property, all your travel expenses that you incur, the plane cost, the rental cost, the hotel, the meals, or whatever, are totally not deductible. However, if you travel out there to tour the property before you buy, and when you come back to your home base, and later you decide to buy the property in that particular calendar year, all your costs that you incur will be amortized over 60 months, essentially over 5 years. Let's say you spend $1,000 of plane fare, then you spend $500 of hotel costs for a couple of nights stay, then you spend a couple $100 on rental car and some other entertainment expenses. Let's say a total of 2,000 you incur to go out on a 3-day trip to visit the property you might want to purchase. When later on you come back to your home base and you buy the property, right? This $2,000 will be amortized over 60 months as indicated on this flow chart. So 60 months is really 5 years. So 5 years divided by $2,000, which is how much? $400. So that $400 can be deducted on your rental tax return on that property that you ultimately purchased. So the $400 will be deducted as a travel expense on your rental tax return for the next 5 years. 400, 400, 400, 400, 400 for the next 5 years on your tax return. Does that make sense? So I answered that question nice and quick, right? So let me see. Rental cap. What do you mean rent cap law? I don't understand, Hey Jing. I know you had a follow-up question. I don't understand. Okay, okay, next question is, if I have a job travel to a particular city often, let's assume Austin, I purchase a home there, but while there, I live there part-time while I lease out the rest of the home. Does that disqualify property as a rental property? Okay, let me read this again. If I have a job travel to a particular city in Austin, yeah, it happens a lot. I purchase a home there, but live there part-time while lease out the rest of the year. Does that disqualify property as a rental property? No. If you rent it out, if you live in Bay Area, you purchase a property in Austin, and you rent out the property most of the year, and some part of the year you may be living there as well. You just calculate the time that you rented out the property. It appears to you the rental activity is much more than your personal activity. So the part of the year that you rented out, you just report the rental income and rental expenses like you normally would. So therefore, that Austin property will qualify as a rental property. So therefore, you can file the Schedule E supplemental income schedule, the rental and depreciation and everything else as normally. Okay. All right. So if I have a rental property subject to asset division, what is the best tax strategy? If I have a rental property subject to asset division, I don't know what you mean by asset division. What's the best tax strategy? Asset division means maybe you are you know joint venture. Maybe you have a partial ownership of your current rental property, right? And you wanna get out of it, right? I mean, you let's say you own 50% of the rental property with another person. The other person owns 50%. You say you have a right partial ownership. Then if you both decide to sell it, and so you sell your portion, you want to do a 1031, then your portion, you just allocate your percentage portion of the ownership and just do the calculation, do the percentage calculation on the rental property profit, losses, and everything else. That's fine, right? So you cover your portion, and the other partner, proportionally based on the percentage of ownership, cover their portion, right? I think hopefully I answer your question. Heijing, you follow with the third question, same question. How will California's new rent cap affect on rental property? Okay, I still do not. Even though I live in California for many many years, I do not own a rental here, so I may not understand. Yeah, I mean, California rules and regulations are very restrictive, and for anybody to own rental property in California because of the is not a landlord friendly state, California. So there's a lot of restrictions. There are rental restrictions in the city of San Francisco, especially, the rent. Oh yeah, I see what you're saying. Yeah, there are several. Yeah, in the city of San Francisco, there are the rental cap, but not everywhere in California have rental cap rates. So you have to determine. I don't know exactly what county, other than San Francisco County, have this rent cap. So okay, hopefully I answered the question. Okay. On your previous question, May, you asked about the asset division due to divorce. Again, you have to look at the divorce agreement to determine the legal dissolution of the divorce and how does it affect that property in question, right? So if the divorce decree states that you will get 50% of the property, however disposition of it, you allocate the 50% of the property as yours, right? So yeah, it's all about divorce decree. What is mentioned on there will determine the profit and tax consequences as a result of liquidating the property, right? So if your divorce decree allow you to, if your spouse allow you to get 100% ownership, then that's the legal definition resolution. So it's all about the divorce agreement, okay? Divorce decree agreement. All right, so right now it's 8:13. There are how many of you remaining? So, well, quite a few of you are still here, so that's good. Okay, let's talk about some properties in Texas. Let me do some Googling. Let's Google Austin, Texas real estate turnkey provider. Turnkey provider, Austin, Texas. Anything that pops up, we can talk about. Okay, let me scroll down. No. So this agent right here, he's a investment real estate agent in Austin, Mr. Ken Venner. Okay, let's see what his website has to say about rental property in Austin, Texas. So let me tell you, in order to buy a cash flow property in Texas these days, the sweet spot, the maximum limit you can cash flow is around 230K. So any prices that are higher than that would not cash flow. Understand? So what you focus on is a property, something like this property here, $159,000 property. This property may cash flow, okay? But right, if this property rents for like 1,300 or 1,400 rent, there's a good possibility. But this is not going to be in downtown Austin. It's not going to be even in the outskirts of Austin, not even Georgetown or, you know, or somewhere. You got to be like 1 hour north of Austin. You know, further away in the suburb, you can find some property 180K, rents for 1,600. That can cash flow. So, yep, Austin is Silicon Valley of the South, but there's a lot of opportunities. But we'll talk more about that in more detail one-on-one if that's what you desire. So, Lori, hello, Lori. You ask about explain again if I can take money to buy property, I can defer the taxes taken out at the time. If you talk about IRA, we had a great discussion on IRA on the last night's training session, how to buy rental property out of state. Lori, I will email you that video replay, and you could watch the 3-hour replay. You know, not the entire 3 hours. You can fast forward the video. You will see 1 hour portion where I discuss how to buy rental property with the IRA. To answer your question from a high level, using your IRA to buy real estate is a powerful, powerful strategy. Yes, you can do that. You can use your self-directed IRA. A lot of people do it these days, at least a lot of people that I'm working with. So basically, you buy the property inside the IRA. Any kind of cash flow and equity appreciation is tax deferral, tax-free during the accumulation phase. If you sell your property inside the IRA, at some point in time, you do not pay capital gains. Is that amazing? Tax-free, tax-free. But you cannot access the rental income inside the IRA, the rental income, the cash flow, until after the age of 59 and a half. Otherwise, if you tap into your cash flow from the property inside the IRA, you have to pay 10% early withdrawal penalty, as well as pay the ordinary taxation of the early distribution of the cash flow. Does that make sense? So when you ultimately, when you retire, then you can tap into the rental property inside the IRA. You can tap into the cash flow. Then at that time, at age 59 and a half or older, you just pay ordinary taxation from the amount of the distribution. Hopefully at that age, at that retirement age, your tax bracket will be lower, so you'll be in a lower tax bracket. That's a theoretical assumption which may not apply sometimes, okay? Did I answer your question, Laurie? You may want to follow up later if you want. Explain again, Laurie, explain again the, if I take money to buy, okay, yeah, okay, never mind. Okay, I think that's, you can ask me again if you want. Yeah, I'll send you the video, don't worry. But yeah, very powerful. I love using IRA. A lot of my investors over the years, I've helped assisted using the IRA to buy. Okay, around this 8:20, I'm running out of questions. Unless I hear a few more questions, I may finish up and log out soon. Now's the time. Forever hold your peace. Uh, so yeah, I have a lot more information about Austin beyond. I'll send you more information on. I know I have all your email, but once again, I cannot present certain things because I'm presenting on behalf of Espositos College. You know what I mean? All right, so let me see what else. Any other questions? I'm searching Google uh, Austin properties. Oh, by the way, since I have let's go with this map, okay? Everybody sees this map. Okay, the best place to buy rental property with high cash flow these days, uh, population growth and job growth and everything else. My personal number one has to be Florida. Okay, and my number two on my personal list is Texas. So let's go with Florida. There are a few hot spots in Florida that I really like. Central Florida, good cash flow. Right here, Central Florida, properties like 150K to 200K, cash flow very well. New construction, single family homes, some duplexes. Then Southwest Florida down here, like Cape Coral, Lehigh Acres, Fort Myers, and LaBelle. And then finally, Tampa, right? Tampa is kind of a part of Central Florida. Tampa Metro, very good cash flow market, new constructions, and Jacksonville, Florida, in northeast corner of Florida. So this four four spots: Central Florida, North Jacksonville, Florida, Southwest Florida, Cape Coral area, and then Tampa. So this is an excellent spot to buy new construction, good cash flow, very nice. Then in Texas, the big four: Dallas up here, Houston over here, Austin over here, and San Antonio down here. The big four. But you buy in the suburbs. You cannot buy in the inner core of those big cities. They're already too expensive, 300, 400,000. So the sweet spot is you buy 160 to 200K in San Antonio or Austin. Suburbs, 1 hour away, 1 hour away into the suburb. That's the price is better. You can cash flow better, right? So that's my big picture explanation. All right. Come on, I need to have a couple more questions. Okay, if I want to purchase property using the IRA, Mei Chen, what is the step-by-step process to kickstart? Yeah, I will send you some email about that after I conclude this presentation. Of course, I have your contact information. I also log in your email into my weekly newsletter, free newsletter database. You get a lot of free contents on a weekly basis. So you will find some free videos and newsletters from my newsletter that you can go from there. But since you ask specific questions offline, I will help you next few days. You have to reach out to me, okay? Because I'm not gonna solicit you. You should have my information. But yes, very, very powerful to buy with the IRA. It's not as difficult as you think. You don't need to learn everything about it. As long as you find the right self-directed IRA custodian. There are several of them in the Bay Area. There's one in Entrust, Entrust. Their headquarters in Oakland, as a matter of fact. They do a lot of self-directed IRAs using real estate, so they are the right person. Then, of course, there are some turnkey provider investment groups in the various part of the country, which will you can pick those property from those areas, and you can get more information offline as well. All right. So, yep, that's good. It's good. A lot of people have IRAs and they don't know what to do with it. Don't keep it in the stock market. You know, diversify into real estate. Very, very powerful. Tax deferral growth, taxable withdrawal at age 59.5. Yep, that's how you do it. Good question, May. So again, any more questions? I think, can you share what is your portfolio like? How many rental properties do you own? I own 10 right now, like 4 of them in Florida, 2 of them in Texas, 1 in South Carolina, 1 in Louisiana, right? Those are my geographical diversification. So, yep, the way I do it, you know, I use the 10-10-10-1 rule, buy 10 properties in different locations, all cash flow properties with 25% down payment. Then have competent property management, do all the dirty work for you. Diversify your portfolio, hold it for at least 10 years. If you want to pay it down, your mortgages, you can using the principal pay down, 1 extra principal per month. You can pay down your 30-year mortgage in about 10 years, free and clear. After 10 years, and you live off the rental income on all your properties. That's one exit strategy if you have the discipline to do so. So there are many different exit strategies, but yep, there's a lot of different ways. So buying turnkey properties, you attended the past 2 nights, May, so you understand the high level of how I would prefer people to do it. All right, so right now is 8:27. Wow, many of you have attended all 3 of my sessions. I really appreciate your time and your commitment and your dedication to hear me talk. Next time when you attend a free live event, if we come in a matter of a Zoom meeting, we can have a more interaction. I may allow you to do audio to respond to my Zoom meeting event, right? You can see my face when I have a Zoom meeting. When I get up to I need to train myself to do the Zoom meeting. Okay, so I'm learning technology just like everybody else, especially for me. I'm from the old school. Well, so again, I really appreciate your time on this, your commitment, your dedication. But I will send you a webinar replay or the entire tonight's presentation. I already sent you with the previous 2, so you have a lot of information to digest. It's nice to have a video recording so you can replay certain areas that you do not clearly understand. So this is your foundation of learning. This 3 module, Monday, Tuesday, and Wednesday night, 3 hours each. Most of you are going to have 3 separate video of 3 hours each, so you can digest and replay. Repetition is the mother of all learning. So, all right, so that's it. I think we have to sign out. So thank you so much for attending my 3 modules, most of you. Some of you that only attended tonight, I will send you the other videos so you can learn more about how to buy rental properties. So you could, hopefully you can learn, you see something unique you might like. All right, so that's it. I'm done. This is Seewing Yee, the instructor for the Las Positas College Community Education. Thank you for attending so much. Good luck. Good night to your financial future. Hope you learn a lot. Thank you so much. Good night. God bless you. Bye-bye.